In the last 48 hours, one of the most respected momentum analysts in the world quietly published what might be the most important gold update of the year, and almost nobody is talking about it. Michael Oliver, the founder of Momentum Structural Analysis, a man who has been running proprietary technical research since 1992, just told his subscribers that the violent sideways correction in gold that started at the end of January is, according to his momentum work, very likely over, and that the next leg up is being signaled right now. Welcome to my channel, I am Bogdan Macro, where we break down the moves in markets that mainstream media either ignores or gets completely wrong. If this kind of analysis helps you see the bigger picture, do me a favor, hit that subscribe button and leave a like, because that is genuinely how more people end up seeing this. It costs you nothing, and it helps more than you realize. So, let's get into what Oliver actually said and why the timing matters so much. On March 31st, Oliver sent a note to King World News laying out his short-term momentum charts on gold and silver. He noted a cluster of pending breakouts to the upside across multiple metrics. Not one or two, a cluster. And some of those breakouts have already been triggered. He said the structure's overhead, and he is referring to resistance levels in his momentum framework, are, in his words, ripe for being broken through. Now, to understand why that matters, you have to understand what gold has been doing since January. Gold hit an all-time high near $5,590 per ounce on January 28. Since then, it has corrected sharply. According to data from JM Bullion, gold was trading around $47.45 as of April 1st. That is roughly a 15 to 19% drawdown from the highs, depending on the exact day you measure. March alone saw gold drop over 13%, which according to CNBC and USA Gold reporting, was the steepest monthly decline since October 2008. Let me translate that. The biggest monthly sell-off in gold in nearly 18 years just happened. And Oliver's response is not panic. His response is that the correction did exactly what it needed to do, and the upside is now resuming. Here is a specific level he flagged in an earlier update on March 27th. Oliver said that if gold settled above $45.28 on the April futures contract, it would clear what he calls the zero line on his weekly momentum chart. He noted that the sensitive weekly momentum indicator had already cleared all the highs from March, which had been kept at that zero line. He said, and I'm paraphrasing, that this was not yet the final all-clear signal, but one of several that indicate a very good chance the spike below the February low was a final cleansing move. The February low he's referencing is $44.23. Gold briefly broke below that level, then rebounded about $500 within just a couple of hours and closed the week back above it. No follow through to the downside whatsoever. In Oliver's framework, that kind of action, a swift break below a prior low followed by an immediate reversal, is classic end of correction behavior. He compared it to a final shakeout designed to flush weak hands before the real move begins. Now, let me put this in a broader context because this correction did not happen in a vacuum. According to a detailed analysis from USA Gold dated March 31st, the dominant catalyst for gold's pullback was the complete evaporation of Federal Reserve rate cut expectations. Fed Chair Jerome Powell, speaking at Harvard, reportedly said the central bank can wait and see how the Iran conflict affects inflation, noting that policymakers typically look through energy-driven price shocks. That translates to neither cutting nor hiking rates, which left gold stuck between safe haven demand on one side and the gravitational pull of a 3.5% to 3.75% funds rate on the other. At the same time, reports surfaced that Russia's central bank has been selling gold to fund its war in Ukraine, and there were rumors that Turkey might sell or borrow against its reserves to defend the lira. Poland's central bank governor even suggested tapping unrealized profits from their gold holdings to fund defense spending. So you had a perfect storm of factors weighing on the paper price of gold through March. But here is where it gets interesting. Separately, each of those headlines looks like a reason to be cautious. Together, they tell you something completely different. They tell you that even with the worst monthly sell-off since 2008, even with the Fed refusing to cut, even with central banks in Russia and Turkey reportedly selling, and even with the Iran war entering its fifth week, gold still bounced hard off the February low and is already recovering. Physical premiums, according to multiple reports, held firm throughout the entire sell-off, suggesting that actual buyers of real metal treated the paper market drawdown as an accumulation opportunity. And Oliver is not the only one reading this correction as a buying opportunity. Wells Fargo raised its year-end 2026 gold target to $6,100 to $6,300 per ounce, up sharply from their previous forecast of $4,500 to $4,700. JP Morgan has a $6,300 target. UBS is at $6,200. Deutsche Bank reiterated $6,000. Goldman Sachs, the most conservative of the group, still sits at $5,400. According to the Street's reporting, the Wells Fargo call was made when gold was near $49.61, and they explicitly described the correction as healthy, with the underlying rally drivers remaining intact. Their note cited lower short-term interest rate prospects and the potential to hedge against accelerating policy surprises. China's central bank had extended its gold buying streak to 15 consecutive months as of January, with holdings rising to 74.19 million ounces. Now Oliver takes all of this a step further. In a separate interview published earlier this year by the Money Metals podcast, he laid out his long-term framework for gold using historical comparisons. He referenced the 1976 corrective low near $100 and the 1980 peak near $850, roughly an 8-fold gain. Then the 2001 to 2011 bull market, which also produced approximately an 8-fold rise to around 1920. He pointed out that the current cycle, starting from the 1050 bear market low, has only delivered about a 4-fold increase so far. If gold were to match prior 8-fold moves, that implies a reference point around $8,500. He is not saying that is a price target with a date on it. He is saying that people who think gold is overdone at current levels are, according to his historical analysis, dramatically underestimating the potential size of this move. Oliver also made a critical point about how gold trades differently now than it did before 2022. This lines up with analysis from Wayne Nutland of Shackleton Advisors, who told CNBC that the period after the Ukraine war upended the traditional relationship between gold, real bond yields, and the dollar. Nutland described the 2024 to early 2026 bull run as structurally different from every prior gold rally because it was driven by central bank reserve diversification, not rate expectations. The Iran war's energy shock has reportedly pushed gold back into its old correlations temporarily, creating what Nutland described as a regime change within a regime change. That is a fancy way of saying the sell-off was about short-term correlations reasserting themselves, not about a change in the fundamental story. Oliver's momentum work appears to be picking up exactly that signal. He is seeing short-term structures resetting and clearing, while the long-term trend remains firmly intact. He described the past 2 months as a violent, mostly sideways corrective process, and his note from March 31st said he is convinced the trigger levels he has identified, especially in what he calls the mama metal gold, will confirm that this correction is over. He narrowed the cluster of short-term momentum signals down to one specific level, though the exact number is reserved for his paying MSA subscribers. Now I want to be clear about something. I am not alleging that any outcome is certain. Markets can do anything in the short term. If the Fed surprises with a hawkish shift, if geopolitical tensions genuinely de-escalate in a meaningful way, or if central bank demand slows more than expected, gold could certainly face additional headwinds. The World Gold Council noted in its 2026 outlook that a successful outcome from current policy directions could reduce geopolitical risk and lead to a stronger dollar, which would pressure gold. HSBC flagged a wide trading range with significant downside risk if conditions tighten. So there are real scenarios where this correction extends rather than resolves. Draw your own conclusions. But what Oliver's work suggests, and what the cluster of major bank forecasts seems to confirm, is that the probability-weighted outcome from current levels leans significantly to the upside. Gold is sitting roughly 15 to 20% below its January highs. Major banks have year-end targets that imply 30 to 43% upside from here. Central bank structural demand. According to JP Morgan, is expected to average around 585 tons per quarter in 2026. And the man whose entire career has been built on reading momentum structures says the correction is showing textbook signs of being complete. So here is my question for you. Given that gold hit 55.90 in January and is now trading around 4700, do you think we see a new all-time high before the end of 2026? Or does this correction have further to run? Drop your answer in the comments. I want to hear what level you're watching. If you found this breakdown useful, send it to one person who needs to see it. That is how this channel grows. Make sure you are subscribed so you do not miss the next update when Oliver's trigger level either confirms or fails. Stay sharp. I will see you in the next one. Oh, and before you go, YouTube thinks you might enjoy this video next, so let me know if they're right.